I wish I'd figured it out at $1 or at $10 or at $111 or at $1,000. But I have this motto, better late than never. Look, I think this is a classic paradigm shift, as Thomas Kuhn would say, in the structure of scientific revolutions. And you can see them with the automobile, with a mobile phone, with airlines, with crude oil. Up until the paradigm shift starts, you could go people tried to create airplanes that flew for hundreds of years. Leonardo da Vinci was thinking about it. And up until 1902, every learned person in the universe could give you a million reasons why airplanes will never work. And in 1903, a couple of bicycle mechanics from Dayton, Ohio, not the people you would think would invent the airplane, they figured it out, bicycle mechanics. And from 1903, Daedalus tried to fly too close to the sun, or Icarus crashes and burns. Thousands of years people have been trying and failing. In 1903, it sort of works. By 1969, we're on the moon. And so the S curve, it kicks up, it accelerates. And with all these technologies, I think the time to buy them is when they're big enough that it's obvious they work and they've got massive momentum. But when 99% of the people on the street don't understand them. And in this particular case, I say it's reasonable. 99.9% of all the assets in the world are in alt assets. $250 trillion in bonds, stock, real estate, precious metals, derivatives. $250 billion in Bitcoin. 0.1%. 10 basis points. I don't think that means that 99.9% of the people don't know, but maybe 99% don't really understand it. So on one hand, we know we're early because it's the solution to $250 trillion worth of a problem. The problem is in an aggressively expanding monetary environment where fiat currency is not going to hold its value, i.e. if I'm sucking 10 or 15% of the energy out of a unit of currency every year, and it depends upon which unit of currency, right? In Argentina or Turkey, we're losing more than 10% energy a year. In the US, we could debate whether it's 10 or whether it's 15. If you looked at the M2 monetary supply, right, maybe it was 5% expansion for 10 years, and now it looks like it's 20% this year. And what's your forecast for next year, right? In an environment where you're expanding the monetary supply, you're sucking the energy out of the unit of currency, all the equities, all the bonds have to be valued as the discounted value of the cash flows. And so the discount rate is equal to the risk-free discount rate. Seems like it's the monetary expansion rate. And so if the money supply is expanding by 10%, the discount rate's got to be 10%, which means that the fundamental underpinnings of a bond based on its cash flows have to be discounted by 10% a year. And an equity has to be the same way. So everybody in the world is, if you've got real estate, you're valuing the real estate based upon the discounted cash flows of the rents. And if you got a bond, you're valuing the bond based upon the sum of the discounted cash flows of the bond. And if you got a stock, you're valuing it based on the sum of the discounted values of the stock and the fiat currency in the system where the entity is doing business, whatever that might be. So everybody's holding those assets. And in a world where the fiat currencies are expanding at 0% a year, there's no problem, right? The underpinning, if the US dollar was expanding at 0% a year, the underpinning of the currency, the base currency layer, is stable. You have hard money. No one's got a problem. And as we expand it, everybody's got a problem. And now you've got a solution. And 99% of the people don't understand the solution. Ergo, we're very early in the S curve, but we're 250 billion into it, which means that when we were at $1 billion, it could have been snuffed out. I mean, you could figure out what could have happened. The IRS could have given you a hostile tax treatment The government could have made it illegal to own it. You could go through a parade of things. The forks could have forked again. Hackers could have found a way to hack the blockchain and drain off the value. Each of those things could have been debilitating to its growth. It's just like starting a fire. It's like you can snuff out the flame, but once it's a forest fire, not so easy to snuff it out, right? So I think that we've got a forest fire. We have a fire in cyberspace. It is raging with $250 billion worth of monetary energy. I think it's too big to stop right now, or at least let's just say it's conceivable to stop the forest fire, but it's a lot harder to stop the forest fire than it is to put out the campfire. It was a campfire when it was $1. If you take as a given that dollars are constant and valuable, then of course you would never trade your dollars for anything that had volatility because you would see that as risky. But if you take as a given that the dollar is going to lose 10% of its value every year, then it changes your frame of reference. I think that a metaphor which is very useful here, or a model that's very useful, is if I'm a company and I have billions of dollars of cash and I'm pretending there's no problem, it's kind of like you have a bunch of kids and someone comes into your home and they turn down the temperature in the kids' room by 10 degrees each year. And you can either stay in your home and in the third or the fourth year, your kids are living in 40-degree temperature. Or you can actually get a new house and you can take a risk and you can move to a new home in a place that you've never lived before, where the sun is shining, where someone's not continually cranking the temperature down. At some point, you got to decide, are you more afraid of moving than you are of staying? And I guess it depends upon whether you actually are paying attention to the children.